Okay, I think now's a good time to get started. Those that aren't here yet can clearly dial in or listen back to the recording later on. So first of all, good morning, good afternoon, depending on where you're seated. Thank you for taking the time to join us today. We're delighted to have you with us. Before we dive into today's discussion, a couple of housekeeping notes first. Firstly, as I said a moment ago, this session is going to be recorded. It's due to last around 30 minutes, depending on any questions that come through from the audience today. And you will all receive a copy of the recording along with any slides that we choose to share during this fireside conversation. This is an open discussion, and we want to make sure this is of value to each and every one of you. So please, we invite you to ask questions, and we will be doing a Q&A session between Roger and I at the very end. So please use the question tab on the bottom right-hand corner, I believe, of your screen to submit any questions, and we will get to those at the end. And finally, I know that from time to time you can lose connection during a webinar. So if you do, please simply use the same link that you used to join today, and you'll be able to get straight back in to the session. So before I introduce Roger, and I'm excited to do so because he's definitely the expert in today's discussion, please allow me to set the scene for why I felt that this was a valuable subject to bring to a session like today. And to do that, I'd like to use a story, an example. And I'd like each of you to imagine that today, the 22nd of June, 2023, you are booked to go and have a meal at your favorite restaurant. This is a restaurant renowned for delivering exceptional gastronomic experiences. Maybe they're Micheline Starred, and their food is second to none. Except this time, rather than sitting at the table and ordering a complete meal, this time you walk over to the reception and you simply ask for the complex ingredients so you can take them home and attempt to recreate that same quality in your kitchen. Sounds crazy, doesn't it? Well, similarly, when it comes to assessing supplier credit risk, we are walking to the desk in most cases and ordering numerous raw financial statements. This is not only time consuming and costly, but honestly, it's also insufficient. And today, Roger and I will be introducing you to a solution known as Modefinance. This is an incredibly smart platform that understands this and acts as, in this context, your skilled chef, combining the ingredients of financials, sector analysis, country-specific factors, leveraging their impressive arsenal of over 25,000 models and considering 15 dimensions. They prepare your supplier credit score that you can trust. And importantly, it's available to you in a matter of milliseconds. It's almost instant, saving you a huge amount of time and effort. So without further ado, first of all, I hope that's been useful, but I'd like now to introduce you to Roger. So Roger, if you'd like to join me, and whilst Roger is turning on his camera and joining today's session, a little bit of background on Roger. He is absolutely a financial industry expert. He's got over 30 years of experience working at a very senior level at some of the largest and most respected financial houses, such as Ernst & Young, Danske Bank, before he set up his own finance company, Tipworks, who, incidentally, in the last 8 years, have raised an impressive 670 million within his local market. So welcome, Roger. Thank you for joining me today.
Thank you, Steve. I know you said the 22nd of June would be the time for the restaurant. Today's the 21st, Steve. So I think the audience still have time to change their mind of how they do things.
You're absolutely right. I'm
thanks
living in the
for a
future
very
again,
kind. Thanks again for a very nice introduction. 30 years, I'm kind of stunned that I'm getting old. But with that, hopefully some experience. Um, and thank you, Kodak, for having me. Hopefully, this will give you some insight to credit risk and credit risk management, which is our core business at TickWorks. I'm not going to talk about TickWorks. The only thing I would say is that, as Steve mentioned, we raise money for small, medium-sized companies in the Swedish market, and we utilize Modefinance ourselves. On the other side, we are also the agent for Modefinance in the Nordics. So we both utilize the product ourselves, and we sell the platform to various parties like Kodiak, who's in turn enable it for your clients. Yes, 30 years experience of finance, banks, New York. I've been in risk management, I would say, for the last 25 years in different positions. We've been working with Modefinance for 6 years, and apart from being a really nice Italian, northern Italian company, very competent, it's been both fun and rewarding. I wanted to set the scene a little bit on Modefinance and what it is, because even if they have the same regulatory status as Standard & Poor's, Moody's, and Fitch and others, they're not as well known. So please, Steve, I know you have some slides that we'd like to share.
Yes,
If you want to turn those on.
Let me go ahead and do that for you. Here we go.
If you look at the first one, this one, we wanted to show this because there's several big institutions using our product. They don't necessarily use it on the supplier side. They use it for their core service being risk management, giving, lending money to corporates, small, big, smaller ones, and they all use it within their operation, or judging customers as well as suppliers. But I would say actually the supply side, which in my mind requires maybe less of credit risk management compared to the customer side who's going to pay you. These are names that utilize and have utilized it for a long time. Our being Modefinance platform and information. And point being, they use it for the core operations. All the banks mentioned use it for the core operations. So, Steve, if you want to move on. Some just facts or stats about Modefinance. I think kind of hard to explain sometimes, but it's really important that this is a regulated credit rating agency with the same status as Standard & Poor's, Moody's, and Fitch. So the meaning of it is that the credit model has been granularly studied, evaluated for predictability. There are names like Gini curves, how accurate their credit opinion is on a company. So that's the core of the company, and core of the complexity is the credit model. So they were very happy in 2016, 2015 when they got the official status as a credit rating agency from ESMA, the European Securities Markets Authority. They produce 25 million scores a year. 25 million companies, that's a whole lot of the world population of companies. They're able to score any company anywhere in the world. It all depends on where they get the data from. But it's a large portion of it. And why so? It's because they are actually suppliers to one of the big data delivery firms, and you might have it actually somewhere in your organization. Three, more than 150 financial institutions rely on Modefinance for the core financial credit risk evaluation. Those institutions are in Europe, Asia, Africa, and Americas. And this is kind of what I want to stress. I think the majority of the audience today is on the corporate side and it's on the supply side. What we're talking about here is actually used by financial institutions who use it for the core operation. Clients are banks, credit institutions, fintechs, and corporates. I would say corporates is actually less than the other parts because of the needs are larger in banks, credit institutions, and fintechs. Corporates has been and is still a very relevant target for Modefinance. But again, the quality of what they do, what we do, is very suited for the banks and the credit institutions. There's some complexity to this, and I mean, I'm a nerd. I love credit risk and credit risk theories and all that stuff. But I also understand this is a very small.
We seem to have lost Roger for a moment, so I'll just give him a couple of seconds to rejoin. I'm sure he will do so shortly. Hello, Roger. Welcome back.
Hi. Thanks. Where did you lose me?
We lost you only a few seconds ago. So
okay, very good.
I think you talked about niche.
Yeah. So the point being on the this is complexity, and it's like Steve was alluding to, trying to make your own kind of Michelin dish or dinner at home. I would be cautious. There's some complex mathematics to this. It's not one model that Modefinance is providing. It's actually 25,000 models that interact, optimize in 15 dimensions. Those dimensions being the regular key ratios that you're all aware of, net debt to EBITDA, etc., etc. Because the whole thing about credit risk is to get the balance between the three parts: solvency, liquidity, and profitability. So, having said that, these guys are very well educated. The 60 people in Modefinance are basically all of them professors or doctors or PhDs in engineering subjects, corporate finance, mechanical engineering, data science, etc. So I think that was just a little bit to set the scene about Modefinance, who maybe not everyone may not be familiar with.
And Roger, I think it's safe to say, I mean, certainly within Kodiak Hub, we have many of our clients using Modefinance within our solution. And one of the key benefits of not just taking advantage of those 25,000 calculations that go into the risks that are brought to us, but the ability then to look outside of what is typically your top 10, 20, 30%, where you're having to manually run those reports. And now all of a sudden you're able to get a financial screening, risk screening on even up to 100% of your suppliers, because it's available at a click of a button. So I think just expanding on that, and thank you for the introduction, but also a little bit of introduction to Modefinance. So a question for you, Roger, is maybe you can share an example or story where Modefinance's solution has significantly impacted a company's risk management process. Maybe you can expand on that for me, Roger.
I wanted to give 3 examples on, not specifically maybe on the supply side. I wanted to look into to understand or to give an impression where we've been playing a big difference. There's one bank who was actually started from scratch, and they needed to decide on a new system. It's called Banca Progetto, and it's based in Milan, in Italy. They decided to build the bank around Modefinance, relying on the credit score throughout the credit process. I've met the CEO of the bank, and obviously they put a lot of requirements for managing the process, which is not relevant for this discussion. But they actually chose the credit model to be the one giving the truth. And I need to say everything about judging credit risk is an opinion. So it's kind of, he chose who he thinks has the best opinion. We have a Swedish bank. They use it for evaluating the most complex credits. So what they do is they run a portfolio, they single out the ones that they think is the most complex. They try to understand based on the scores what to focus on. Um, a third one is an Italian factoring player where they actually used Modefinance to speed up the process, increase automation, increase digitization, which is the name of the game at a lot of places today. I think the the common thread on all three is that Modefinance has been able to give the client an ability to focus on what's most important. So kind of single out where the issues are, dive further into the issues. My experience as a credit guy is that you don't get all the truth by just looking at the numbers. What you want to do is to single out the ones that you want to focus on, which I think Modefinance does a great work of doing. Then you can take on like the 10% worst, you can take a deeper look.
So again, just to expand on that point, and a question I would like to ask you again, Roger, is, I guess in your opinion, why Modefinance? What is the key difference between this model and what is typically common, which I guess is reviewing those extensive financial reports?
Well, it's a good question because I think our main competitor is like the old ways of doing things and also utilizing Excel in like your own proprietary setup in Excel. I think the main difference is that, I mean, first of all, it's a complex subject. So what we have here is key, very educated people who's developed a credit risk model. It's been tested by somebody else, and by using it, and I would be the advocate to use it for like the 100% of the population, single out the most difficult ones and look deeper into those, maybe with the way you've done things before, but not to do it for everyone. So I think the big difference is that it allows you to capture a bigger population and enable you to focus more time on the more complex ones, maybe giving you time to call up the client. So I'm not advocating automation by reducing anyone who's doing this. It's a tool to improve the quality. That would I, because the subject is very complex. I think today, in at least what we have up in Sweden, it's we have a severe downturn in the economy. A lot of companies are struggling. You want to understand early what those issues could be.
And I guess that's another something else that should also be taken into consideration, because when you're often looking at financial risk for a supplier, maybe you do it when you first onboard the supplier and you look at their accounts, and then maybe or maybe not, you do that once every 12 months, 2 years, 3 years. The beauty, again, of having Modefinance plugged in is that there are consistent reports being run, in a lot of cases, automatically. Therefore, when something changes, rather than you having to find it because you've run a report or reviewed, again, more financial reports, it has the ability to notify you and let you know, again, keeping you ahead of any risk that could be
Right.
contributed.
And I was just add a little bit, I mean, on your solution of Insight, you just add the corporate or the VAT number, the EU VAT number. What you get out is the key aspects of solvency, liquidity, and profitability. And a skilled financial person will know or understand that I want to see some balance between the three. If I have an issue, I should look at deeper into like a more extensive report. And I know some of the data houses or providers are providing those reports. If they're more than 4 pages and you have a lot of suppliers, there's no way you can
Yeah.
really cover it all. So again, looking at the core aspects of credit risk, single out the ones, then you can look at some more extensive reports.
I think as well, with that, Roger, sorry to interject. I was speaking with a customer just last week, and there was two wins for them. One, they had a finance team that were previously responsible for reviewing, obviously, the financial risk of any new suppliers that were coming on. Now, that was fine when they were taking on 5 or 6 suppliers a year. They're now taking on 5 or 6 new suppliers a week. So from a finance department, that became very time consuming and was a blocker for a lot of other things that they need to focus on. But also from the procurement team that were looking to take that supplier on, it was a bottleneck because it meant that they were waiting for these financial reports or evaluations to come back before they could move forward and accept that supplier, etc. In today's world, with the addition of Modefinance, what they're now able to do is, first of all, from the finance team, they've been able to let go, but put some clear structure and framework around it. If they score below X in any of these fields, then we need to then understand it. That means that actually it's less than 5% of those suppliers actually come to the attention of the finance team because the rest meet their acceptance criteria. But also from procurement, they're no longer having to wait for finance. So the efficiency level has obviously gone through the roof, but also the speed in which they're able to accept new suppliers has also increased, removing that bottleneck. And that's just one example where it can be incredibly valuable on multiple levels, depending on what positions you're in.
Yeah, I would say also extend the search. I mean, a lot of those companies, they're part of a group. You may want to understand how the group works.
Yeah.
If you have 5 companies in the group, the report is 4 or 5 pages. All of a sudden, there's 25 pages to go through.
Yes.
Instead of looking at the key aspects and maybe you extend the search for the other parts of the group to understand.
Yeah, I think the other thing there as well, Roger, and again within our solution, because you can monitor uncorrect reports. You can actually then run a report on your supplier network, so you can see what is the status quo and who is above or below in any of these risk areas that are being picked out from the reports, rather than having to trawl through individual reports which aren't necessarily registered or recorded anywhere other than on that document. Having them in a solution like this means that you can suddenly get more ownership and compliance around that review process. Sorry, Roger, I interrupted.
No, I totally agree. I think the key point is to understand that credit risk is the balance.
Yeah.
And what we are licensed by ESMA for looking at is our judgment on solvency, liquidity, and profitability, as well as the overall credit risk. And that's what you get in Finsight. I mean, yeah, it should be enough. And if you need more, I think the next step would be rather than looking at analyst reports or anything else, I would spend time and trying to talk to the company if you see any issues.
And I think you mentioned ESMA there as well, Roger, and I don't want that to be kind of washed over. So just expand on the importance of ESMA and what that means for Modefinance in terms of how you should trust what they're delivering.
It's kind of license to cook,
Okay.
if we allude to well, ESMA is to some extent it's the Michelin. We get a certificate. We're allowed to call ourselves a rating institute. You and I, Steve, we could start a credit scoring company today, say we issue scores, and sometimes we would say ratings, but it's not ratings because ratings is a really regulated item.
Right.
You're not allowed to call yourself a rating agency unless you have ESMA's license, and that's it's a European regulator. We can passport the license to the US or to Asia, and it is. They test it. It's a cumbersome process. I've tried to get the CEO of Modefinance to confess that whether it was deliberate application from the beginning. I think it was kind of, let's try it and see if we pass through the needle's eye, and they did.
Okay.
Because they're good. Because they're good. So it's a scrutiny, and they get scrutinized every year. For us in Sweden, people would think about Italian companies and have different opinions, and it's built on from the origin on the piccolo, medie imprese, the small medium-sized Italian companies. But ESMA has tested it, and it works for large companies as well. So the model is kind of universal in that sense. It takes care and into account both the heritage or the location of the company, the industry, and when it judges the figures. So
And I think
it's really important.
And I think and I'm pleased to say we're having lots of questions come in from the audience today. So I've just got one more question, because I know we promised we would complete this session within 30 minutes, and I want to stay true to that. We did start 2 minutes after the hour, so I will take those. But a final question from me, and then we'll move on to the audience questions. If you were an industry company managing thousands of suppliers, like many of those that are dialed in today are, how would you design your evaluation of suppliers with Modefinance on board?
I think we covered a little bit that question. I think I would use the tool to single out the most important issues. Easily find out. You would have thresholds on either the overall credit grade you get, if it's a double B or triple B or single B, where you have a threshold. Below the threshold you look further, or you have deviations on solvency, liquidity, or profitability, and that could be kind of set by policy. So you as an evaluator have your back, free on the way you judge things, rely on a policy. Then you're able to screen everyone efficiently, relying on the credit model. Then if you want, I don't say you need to, you could very well use it for the 100% and be fine with that, because what I'm saying is it's a good credit model. But if you really want to be safe, larger exposures, those who are close to the threshold, take a further look. Or if it's a really strategic supplier, take a further look.
Perfect.
But don't do that for all of them. That's not today's automized world, how we do things.
Very good. And before we just go on to the questions from the audience, and I'm excited to do so, I'm just going to, for anybody that's keen to understand a little bit more, maybe see the solution visualized in terms of how it looks, how those ratings are displayed, and how easy it is to use, then I'm just going to put a link on your screen now where you can book a call with us, and literally all you need to do is click the link. It'll open up a diary, and you can schedule that in. It'll be our pleasure, of course, to answer any questions you have and to again visualize the solution for you. I appreciate that's something we haven't focused on today. It was more conceptual today in terms of the call. And while that's open, I think it's a good time just to go into the questions. Please feel free, if you have any more questions that you would like to share, then feel free to share them with us. The first question I have here, Roger, is from Amy Leverington. So thank you, Amy. In fact, this one's for me. It says, Steve, can you tell us how this would work in your solution? Yeah, absolutely, Amy. It's for those of you that don't know, Kodiak Hub, we are a best of breed supplier relationship management platform. We are known for being a one-stop shop for all supplier data, which means we're a modular platform. We're pulling data in from various sources. Modefinance sits within our solution. And in fact, we've got one of the USPs of our solution is we've got a one-page scorecard, supplier scorecard, which is like a 360-degree view of your supplier. It sits perfectly within there. There'll be a credit score at the top and the ability to delve into those 7 areas that Roger shared with you. Beautifully simple. Again, Amy, if you'd like to see that, then feel free to book a call. It'd be my pleasure to, and anybody else, be my pleasure to show you what that looks like. Second question is from a James Wild. This one's definitely for you, Roger. Is this more cost effective than buying financial reports? I guess that's what James is doing today. So you've got more experience than I have when it comes to financial reports, Roger. So please, if you can answer that one, that'd be great.
I don't know the exact price for Finsight to Kodiak, but I think it's a lot cheaper than buying financial reports. Financial reports are usually very expensive. Data is very expensive. And I think the solution you can get to Finsight is a lot more efficient. If you would buy reports for all of your suppliers, that's going to be really expensive. And I've seen companies doing it because they used to do it, but it's a lot more cost efficient.
And I think also that the savings go beyond the report itself. Yeah, first of all, you're right. Like Roger mentioned, anything to do with data is expensive and is getting more expensive. With what you're getting through Modefinance is a rating card rather than an individual data report itself, which is going to be, significantly less expensive than what you're used to. And I think just following on from something Roger mentioned earlier, we're not saying you won't need financial reports. You want to delve in deeper with certain suppliers, but actually you might be able to ask for that information back from the suppliers, which means you're not purchasing it based on what you've seen within the Modefinance report or Finsight. And the second thing, the second big saving is time. It's so much more efficient. And that operational saving will be significant for you, James. George has asked.
Steve, there's one. I can see the questions as well here. There's great. One question I'd like to answer, and that's which would be the main indicators as solvency, liquidity, and solvency. Those are easy. Well, for me, it's easy. I'm used to the rating scale from AAA to D to B, triple B, double B, single B. I think most of you know about the scale. Those are used for the overall credit score you get on a supplier. It's a triple B. It may be a single B on solvency, a double B on liquidity, but a single A on profitability. That builds up your score being a triple B, for example. So that's a scale. If anyone wants, I'm sure Steve through us can provide what's the actual probability of default behind, which is a mathematical calculation of what the actual default rate within a 1-year horizon would be. So that can be provided as well.
Again, anything we don't cover off today, if you're not ready to schedule a call with us, just get in touch with Kodiak Hub. You'll find us online in most places, or on LinkedIn or wherever you like, and then we'll certainly come back to you with questions. But like I say, you will be getting an email from us, so feel free also to respond to that email. I know we've just run out. I've got one more question that I want to ask, and then the rest of you that have asked questions that we haven't got round to, I'll be sure to do that, or Roger and I will do that separately beyond the webinar. The first one I can answer really quickly. How quickly do you get the ratings report? Well, it's instant, as Roger mentioned. All you need is a company reference number or VAT registration number, and it will instantly pull that rating for you. And then one final question here. Does Modefinance include notifications? Should the risk or change good or bad? I think that's really a great way to end this, because one of the great things about having Modefinance, and I think we covered this within the discussion, is that it's constantly there in the background, reviewing every single one of your suppliers. And absolutely, within our solution, if those ratings change based on your specific requirements, then notifications will support that. So you will always be prompted when there is something that might impact the risk element of your suppliers and their finances. Roger, before we close out, yes, please.
There's an important question. Somebody said there's 333 million companies globally. 25 million is what I mentioned. I think our core and also the data availability is primarily in Europe. We're looking at expanding the universe, but we can rate or score any company in the world, Pakistani, whatever you have, as long as there's a balance sheet and an income statement. The problem we face is always if there's no data, we cannot produce anything. There's nothing to cook the dinner on. So, but I would say out of the companies that are providing data, we are covering it. The US only listed companies provide the data, so that's a big issue. I hope that answered the anonymous user number 2's question.
Perfect. Thank you, Roger. And I think we've just gone slightly over time now, so I like not to go too far over what I've promised. So Roger, I'll take this opportunity to thank you for joining me today. I'd also like to thank everybody that took the time out of their day to join us for this session. We hope this has been useful. And please, should you have any questions at all, or need any support, or just want to know a little bit more about how Modefinance works, then feel free to respond to the email, book a call, and we'll be very happy to talk through that with you on a one-to-one basis. Have a great rest of your day. Thanks, Roger. Thanks, guys. Bye-bye now.
Thank you. Bye-bye.